Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Boom. We are back. Andrew Kuhn, Focused Compounding Podcast. Geoff Gannon, Focused Compounding Podcast. How's it going?
Very well. How's it going with you?
It is going fantastic. It was 94 degrees yesterday. I don't know what it was today. I didn't look. It was kind of hot today, but yesterday it was 94 degrees. Can you believe it?
Yes, I was out there, so I could believe it.
My mom texted me. She's in Illinois, or we were talking on the phone, and she was like, "Is it starting to heat up there?" And I'm like, "Yeah, it's like 94 degrees." She was like, "Oh my gosh!" And she said in Illinois it was like 70s something. Getting incredibly hot here. Hope everybody is doing well. Thanks so much for tuning in with us here today. If you're not following me on Twitter, why aren't you? At Focused Compound. Tweeting something out once a day for the next 30 days.
Okay.
And then forever going forward. Isn't that right, Geoff?
Yep.
If you like the work we're doing here, please leave us a rating and review. It helps us out a lot. So today we're going to be talking about cheapness versus quality.
Okay.
I think this is sort of like the value/growth, sort of line in the sand when it comes to like investing. And a lot of people spend a lot of time thinking about it. And there's some people that are pretty interested to hear your thoughts on it.
Okay, so this came from questions that you got from Twitter?
Yeah,
okay.
But it's also, I think, a pretty hot topic in the value investing world, right?
Absolutely, yeah.
So I'll kind of group it together. But the question, it says, what do you think is more important, cheapness or quality? I guess you can't have both. But he says cheapness or quality. He says Berkowitz versus Terry Smith. Which Bruce Berkowitz, Terry Smith, who is he talking about?
Fundsmith is what he does in the UK, yeah.
Okay, there you go. So what are your thoughts on that?
They both work when taken to their extremes. So I think if you own an extremely high-quality business for a long time, you'll do well. And if you buy an extremely cheap stock, you will do well. There is a catch with both of them that it may turn out that you've bought something that isn't that high quality that you thought, and with value that you bought something you thought was a high value, which turns out not to have the assets that you thought or the earnings that you thought. So this gets tricky because of the academic side of it, which is if you just do this quantitatively, you can try to answer it. But I'm not sure that, like, when a lot of people talk about what's a high quality business or what's a value stock, some of the stocks they list from a screen are not what I would call a value stock or what I would call high quality.
So like, what do they, for people listening, what do they call a value stock that you think is incorrect?
Low price to book.
Okay.
No matter what. So it could be low price to book. It could be a low price to book life insurer.
Sure.
Which has no special means of distribution or something. Right?
Yeah.
So if they were doing like, they got all their clients through direct mail that they do in this cheap way and whatever, then maybe. But they're selling through agents and things like that in a way that all sorts of other life insurers are. They're not going to have an advantage that way. If they're investing all in bonds that don't have very high returns, this is a company that's going to have a return on equity of 6% a year forever,
Sure.
So it should trade at a low price to book.
Yeah.
So it's not a value stock in the same way that something that earns decent returns on equity would be, Also, in that category I've talked about before, like net nets and things like that. Net nets that were once profitable are value stocks, but net nets that are just they went public, they never really had much of a business. In the internet age, there were some of these companies. They raised a lot of capital in an IPO, so they had a lot of cash, and now they're trading below net cash. I don't know. There's no real business there. Ben Graham never wrote about that. He wrote about businesses that were trading below net current assets and net cash and could be liquidated for more than they're worth, but actually were real businesses.
Sure.
So when you have things like Chinese reverse merger frauds, which people would bring to me and say it's a net, technically, yeah, it's technically a net, but I wouldn't count that. So there's a difference between like what a computer or an academic using a computer will say is a value stock and what actual value investors should find, So I would think that they would find things that, it goes the other way too, which is like a stock might have a high price to book, but be trade for less than what its assets are. Common examples are land things. We talked about that before. Mm-hmm. So we talked about some examples. Example we've used before is like Maui land and pineapple, which if it was at 2 or 4 times book value, would probably still be less than the land is worth because it's land on Maui and it's on the books at
like
prices from, none of the prices that I remember are from after the 30s, and a lot of it's from before then. Yeah. Mm-hmm. So, but
if you had to pick one camp to sit in, where would you sit? Or does it depend on the market? Because, how do you think, I guess, quality companies, which stocks do you think would perform better in, let's say, a bear market? Value stocks?
Yeah. No, value stocks perform best in a recovery from a bear market, in the first stage of a bull market.
Okay.
Yeah.
So if you had to pick...
quality stocks, if they don't have crazy multiples, would perform fine in a down market. But what happens is you get like the Nifty 50 or something, or the end of the .com period. So you have Coke at 60 times earnings.
Yeah.
Well, of course it's going to go down then. But if Coke was at 25 times earnings, it wouldn't go down that much. It's just that last few years where it went to a crazy price. Yeah.
Do you think people forget about the value camp because the market has been, it's been more volatile probably this year than it has in I guess you can still, we're up about 10 or 11% of the year. But do you think people sort of forget about the value camp because the market has generally just been kind of going up? Like all tech stocks, for example, FANG, it's just been going up every single day.
Yeah.
So then there's these incredible multiples that are people willing to pay. I've spoken to people before, and I know I've told you this privately. I know a couple people who they say they're perfectly happy paying 40 times EBIT for a great business.
Right.
And I know, even without even coming to you first to talk to you about this, I knew Geoff Gannon would never pay 40 times EBIT for a great business.
Correct.
So it's almost like your style of value investing, in my mind, is completely different than these other value investors who are okay paying these crazy multiples because the business is growing so fast.
Yeah.
So my question is, does that work well in a bear market? In a bull market?
Yeah.
As opposed to a bear market.
Yeah, in the last stages of a bull market, buying some of the most expensive things will perform best, probably.
Mm-hmm. In
the very last stages, that will perform the best of anything, probably.
Yeah, and you did a blog post once on, I think it was on like handy picking a stock and like the right multiples to choose.
Okay, yeah.
Do you remember the specifics about it? How would you go about paying X multiple for a stock that was growing X percent?
Oh, okay. So here's the thing. So technically, it's not impossible to make money paying 40 times earnings or something, even for some stocks that don't have really high growth rates. The issue mostly has to do with the durability. So it'd have to do with very high returns, or high enough returns on capital for a very, very long period of time. Like some people would ask me, what did I think BWX Technologies multiple should be? Because the multiple was maybe 15 or something when we bought it. Like when we wrote it up for the Singular Diligence report. In theory, it should be really high. Sure, it should in theory be 30 times or something, because you have very high return contracts with the U.S. Navy that you're fulfilling, and you're likely to know what the Navy's going to do for the next 30 years or something. So sure, yeah. And maybe See's Candy should be really high. And maybe Coke, if it was growing, much, should be really high. Eventually, some of them don't grow at all, though, and then that multiple would have to come down a huge amount. But the big thing with so I consider myself a value investor, but I was talking to someone recently, and I said, what that means mostly in terms of what I do every day is we'd like to buy things that we would like to buy things at less than 13 times earnings, and we're probably not going to pay more than 30 times earnings for anything. Continue to own something that goes to past 30 times earnings, no matter how good it is. That may not be the smartest thing generally, but even if we owned a Coca-Cola, I don't think we would own it. Back when Buffett bought it, in the late 80s, or I don't think we would continue to hold it at some point where it went over 30 times earnings.
Why do you think he didn't sell it?
Because he had said things about it, and it was in Berkshire at the time. If he was running the partnership, I think he would have just sold it. Yeah, it was just because it was Berkshire that way. I mean, it's hard for him. He has an incredible amount of money. He has to find something else to put it into.
Yeah.
A lot of stocks were expensive in the late 90s. It's not like Coke got expensive and everything else stayed cheap.
Yeah.
Yeah. I mean, so even when we're talking about a high quality business, we try to pay a low price. So, I mean, I like quality a lot. I just wrote a letter to clients where I talked about saying that the stock that we bought, I thought fit the definition of what Buffett talks about as an inevitable, that it's the inevitable leader in its field. You know, that 10, 20, 30 years from now, it'll still be selling the most of what it does. But we paid 9 times earnings, or a little less than 9 times earnings for it. So, yeah, I like quality a lot. I don't want to buy the number 2 or number 3 in that industry. I want to buy the number 1.
Sure.
But yeah, I'd like to buy it at 9 times earnings, not 19 or 29.
Do you think it's 9 times earnings because...
I don't know. I think because its industry hasn't been hot since the housing bust, so a very long time.
Because it's not a United States company, that's all I'll say about the business.
Yeah. And, things like that. So, yeah, and less liquid than some, and no analyst coverage, and just things like that, sure.
Do you think and I don't know if you've ran some studies on this, if you bought a basket of just cheap stocks and a basket of just high-quality stocks, what do you think would perform better? Cheap ones?
So I've looked at that somewhat.
But I guess it's kind of hard to quantify, right? Because at what price are you paying for the high quality, or are you just kind of, I mean, you're probably not disregarding it altogether, right?
But I'll give you an example, and it's closer than people think. So if you buy... So people tend to think that if you buy nets, you have to sell them really fast because holding them for a long time doesn't work. And that's not really true, because I've done some back tests of certain things to see on a breakdown by stock what really happens. The problem with nets is that some of them go to zero. So selecting the wrong nets is the problem. But actually, if you select a decent net, the ones that perform well could outperform the market if you bought them and held them for like 10 years. I mean, they really can. And the math works pretty well that way, because if you think about how cheap a net is, and you say, okay, well, if something goes from 2/3 of net current asset value, let's say, to, probably almost 2 times net current asset value, or something being more of a normal price for something. That's not a normal price for stock exactly, but that's the kind of thing it would go to. It's not going to just go to 1 times net current assets. That's basically a triple right there. So even if the stock doesn't grow earnings and things, if it triples in price, you can afford to hold something that takes 10 years to triple. Sure. That actually works out fine.
Yeah.
And it will grow a little bit. And the same thing with quality. There have been tests of things like what would have really happened if you bought the Nifty 50. And the answer is the longer and longer you held it, the more okay it would have done, because a bunch of those companies did fine. The danger is that a few of those companies really declined. They turned out not to be as good as Coke and things like that. You had some in there that, you have some that were, eventually were things like Polaroid and Xerox and things that, had inventions that are not a big part of our economy now.
When you think about and you also wrote another blog post about this, like Amazon, Facebook, and Google, like how big can they get? At what price is it too high of a multiple because the business is already so big? Well,
mathematically, it's hard to say. For me, they've for a long, long time have been in that range where it's just too much to pay, because the certainty that you'd have to have is so high. That's what we're really talking about here, is that you'd have to have, it's really the certainty that you have, not what the growth rate might be.
Yeah.
So yeah, those are, a lot of those are high multiples, but not all of them. I could see some people defending, I could see some people defending Google or something like that. There'd be more trouble with, Netflix or something like that. Yeah.
What do you think about Berkshire buying Amazon, which obviously wasn't Warren?
Right. That, makes sense for them with how much money they have to manage. I think the average person shouldn't buy, FANG stocks, because I don't think the average person doesn't have a need to buy them. And I think there are a lot of stocks out there that have some advantages. I think we tend to overstate and get too focused on talking about those sorts of things. They become like a fad that way,
Sure.
There's substance to that fad. These are real companies that are earning a lot of money in most cases, and they're growing very fast, and they have great returns on capital and all that. But why are we only talking about those and not talking about anything else? We just had
Is it because it's sexy, right?
Yeah. Well, we just had a write-up on the so FocusCompoundingGazette.com has it, and that goes out each week to people and stuff. But it's the write-up that's at the website. So the full write-up's at Focus Compounding. and it's about Games Workshop, which is a stock in the UK that does the biggest IP they have is Warhammer 40,000, but they also have the Warhammer Fantasy World 2 as well. So they're the Warhammer, and it has 50% returns on capital kind of things. It's grown like 20-30% a year in terms of sales the last couple of years. It has as wide a moat as probably I've seen in entertainment type stuff. But and it's a hot stock now compared to what it used to be. But it's not like a FANG type stock in terms of the multiples that it ends up getting, or in terms of just everyone obsessing about those particular stocks. There's lots of stocks that have, pretty wide moats in different things. Even some of the most expensive things that I've talked about on this podcast, even when I talk about something like BWX Technologies, very expensive stock from basically all the time we've been doing this podcast, I think. It's not as talked about as much as, those sorts of, FANG type stocks and things like that.
Yeah, it's kind of like a cult following, right?
Yeah, I mean, there's lots of high quality businesses out there. There are lots of companies with wide moats. A lot of them get expensive, but you don't have to talk about them. You don't have to see if you're reading media things and stuff. It's all about a small number of stocks. That's what it's always about. Yeah. It's also about a small number of trends in our society and stuff.
Well, that's the thing, right? Who wants to read about nuclear reactors in the Navy or video games or whatever the heck you just talked about, right? It's just like, and I feel like Amazon, Jeff Bezos is always in the news, right? And Netflix is in the news always, like in the hunt with Hulu. It's like all these companies, and like Apple and Tim Cook, Google, they're good viewership, right? For media companies.
Yeah. And there's trends that follow those same things too, where people talk about all the time about, self-driving cars and cannabis and things like that now. And that might change, Those things don't have any real substance to them as compared to the stocks that we're talking about. But the fact that people are talking about those stocks is often can be the personalities involved, those sorts of things. I remember, when I started investing and stuff, the most likely company on like the front of your, your Forbes and your Fortune stuff was probably GE. And then if and now they might talk about GE in terms of the bad things that are happening there.
Sure,
but also just talk about it less.
Yeah, well, I mean, the types of companies people look for, I feel like, now I don't know from your experience, but it's like me, it's like there's always like these new public offerings and all these cool companies. I mean, when you first started, was it still like industrial type, like like GE or like Coca-Cola, all these companies that people now would probably consider boring?
Some of it was, but a lot was internet stuff. A huge amount was internet stuff, and there was less substances in internet things than there are in the ones that are left today, But we've had a bunch of IPOs of other sorts of things. So.
What do you think about companies, and this is sort of off topic, but what do you think about companies going public later?
I think they have to because they lose money longer.
Really?
Yeah.
I mean, because it's like, Uber going public, and I'm kind of going a completely different direction. I'll bring it back. But they're talking about like Uber going public, and it's like Uber's like been around for like 8 years. It's like a mature company that still loses billions of dollars a year.
It's a whole nother category. I don't know what to say about those. I mean, I don't want to upset people by saying what I think about those sorts of things. But but some of these are of a completely different type than what we've seen before in public markets.
Yeah.
These are companies that have lost money while scaling up to very large size because people are, buy into the Netflix and Amazon thing, which is okay. So once we get really big scale, then we can achieve these sorts of returns. So it makes sense to invest in early on in, years where you don't make money. And that's true to some extent, but there's also business models that no matter how much you scale them up will never make a lot of money. And so some of those I don't.
Amazon has an $874 billion market cap, and it's trading, if CNN Money is correct, which we'll take it for it is, at 72 times earnings.
Okay.
It's kind of, let's see, Netflix trading, 126 times earnings.
The number that I would use more for like something like Netflix, for instance,
probably price to sales.
Yeah, price to sales is too high at Netflix.
Well, there you go.
That's the problem.
7.6.
That's the problem, is that the price to sales is too high.
And then you go to Amazon, it's only 3. And then Apple.
For instance, when I think about these things, I'm thinking in my head, what's the most expensive price to sales stock we own? I know what it is. I know what its margins are. I don't think Netflix will ever have the same margins that our stock has, and it's trading for a higher price to sales already.
Yeah.
So I don't know what to do with that. You have to have incredible margins to support a price to sales at that sort of level. But the issue is...
But people in the quality camp, their argument is that revenue is going to continue to accelerate.
Yes.
So it's worth paying the high multiples for these companies.
let's put it this way. If we're having this discussion right now about cheapness or quality, what should you bet on?
Yeah.
You should all be betting on cheapness
Yes.
right now, today. But not necessarily long term. It's just that cheapness is cheap and quality is expensive right now.
Yeah.
And I mean, people are there's too much, especially among value investor types and things like that, have adopted the sort of ideas of wide moat stuff to such an extent now that it's not as attractive a place to invest in as it once was. That's all I'm saying. People have gotten too caught up in that because it's become too comfortable. It's performed too well recently. But that's not true generally. I want to buy quality things.
Sure.
And I don't have a real preference. Although I say I'm a value investor, I don't have a preference for buying things that are a bit cheaper if I think that they're not the leader in their field or something. I much prefer having the company with the wider moat, with the stronger position long term in an industry. But that's so expensive in some cases with some of these things. Where you have the quality growth thing. I mean, all of these are things where I think the value investors say, I mean, I don't know, you might know better than me about this, but they say that they have wide moats. Right? Isn't that what we're talking about with all the FANG things?
Yeah, absolutely. Yeah.
So you have some people who say they're value investors.
Absolutely.
And yet they own FANG stocks.
Uh-huh.
They know they're paying a high price.
Because they think they're incredible businesses. And the moats are enormous. And
right.
Yeah.
So, and I don't think they're wrong about that, but I think that they're paying a lot right now. And the time to buy those things is when that's less true. There's so many stocks that I've owned in the past or considered buying in the past that are so expensive now versus what they once were. And they just aren't going to offer the same returns. I like quality as much as anyone else probably, but I'm not willing to pay a lot for it. So, I've talked about before, I paid, 10, 11, maybe 11 times free cash flow for FICO after the financial crisis, so 2009, about 10 years ago. My guess is the stock is a 30-something PE right now. It's not growing any faster. None of those things are true. It's just 3 times more expensive. So it's as sure a thing as it was 10 years ago in terms of the business, but the stock isn't. If you triple the price that you're paying, it becomes not a sure thing.
Sure.
Yeah.
Got it. Cool. We're going to do what we did on our last episode.
Okay.
We're going to switch over to our YouTube segment. So this is the end of the podcast. I want to thank everybody so much for tuning in with us. If you want to listen to the extended version, which we're going to be going over a few more questions, head over to YouTube, type in Focused Compounding, and you'll see the extended version of this podcast. I want to thank everybody so much for tuning in with us. Feel free to leave a rating and review. That helps spread the word for Geoff and myself, and obviously we're greatly appreciative of that. We'll see you on the YouTube side. Take care. All right, we're back.
Okay.
We're on YouTube.
Yep.
Can you see our face? They can't see our face.
Nope.
They can't see our face. We've got a lot of questions about that, but we haven't done that. So we're going to be answering some more questions.
Okay.
Let's be taking some more questions. And one of them is along the lines of the first part of this podcast. Okay. So we'll hit on that again. And then we have a couple more questions that we're going to pull and kind of see where they take us. So the first question, if I can find it, I'm going to have to actually cut
this would make a great video.
Yeah, I know, right? This would be funny, wouldn't it? Where'd it go? Hold on. I had it written down. Maybe he DM'd me. There we go. He DM'd me. Okay. So it says, a question I struggle with. Academic background tests suggest companies with high returns / moats don't in aggregate outperform. Valuation is far more important factor. And he referenced Toby Carlisle's work. How do you guys think about this? And I guess that kind of leads into the first part of this podcast, like sort of the quality and the cheapness camp. And to give a little bit of background on Toby, he wrote a book called Deep Value. Yep. I think the inspiration for the book came from Joel Greenblatt's You Can Be a Stock Market Genius, where he tested high quality being high returns on capital and return on invested capital, or his version of it, and cheapness being earning his version of earnings yield.
Right, the little book that beats the market.
Yeah, the little book that beats market. And what did I say?
You Can Be a Stock Market Genius.
Oh, shoot, my bad. Yeah, that's what I'm talking about. And then so Toby took this, sort of this concept and actually just tested cheap stocks against that, and he found that actually if you just buy cheap companies that have a high earnings yield, which shows the EBIT relative to the enterprise value, that you could do better, right? So what are your thoughts on that?
I think Toby's right. I think it doesn't matter. I think neither of those things matter. I don't think the little book that beats the market matters, and I don't think that using EV to EBITDA alone matters, because investors are not getting the returns of either of those things. The average person listening to this is not getting the great returns that you could get by using either of those formulas and sticking to them religiously, never deviating from them, even when they underperform for a while and things like that. The biggest issue is it's not the efficiency of what we're talking about what actually outperforms by the absolute most amount. It's like, I remember once, people were having arguments about net nets. Should I only buy net nets that are profitable, or should I also buy the unprofitable ones because some studies showed the unprofitable ones outperform the profitable ones? Well, when you're talking about 20%, 30%, sorts of returns and stuff like that, it doesn't matter. I invest in Japan, and people argue about, well, what exact rules do you use, and what they made 50% a year in Japanese yen terms, right?
Yeah.
It doesn't matter. You're getting returns that are very big and different just by doing this. You're just buying net cash, whatever, it goes up. So the same idea. Both of those things should work. That's fine, and that's all that people need to know about it. In terms of so does that mean quality doesn't matter at all? No, of course not. What's Toby's talking about or something like that is it's a question of how people bet on these things that matters. If people so overvalue moats or are so bad at picking out moats, then it doesn't matter, because the cheap things will mean revert, and they will start to have higher returns on capital, and so you won't need to buy the higher return things. Now, I've always said, I think the problem with the magic formula, though, which is the Greenblatt thing you're talking about, is it's a naive strategy. It's a dumb strategy that isn't trying to apply an idea so people own thought to it.
Yeah.
Which is, it's not a wide moat approach at all. It's the opposite of that. It's saying buy things that have the highest returns on capital. I can think of lots of businesses that have high returns on capital but probably don't have moats.
Do you think, though, that was his point, though, to it, was he wrote the book for his kids, really? And if you read the instructions on it, it's really just throwing darts.
Yeah.
And then sort of rebalancing it once a year.
I think EV to EBITDA will work better than what he did.
Really? Got it.
Probably. There's no reason to do what he did. But that's just like when I talk about indexing or something, I tell someone buying all 30 Dow stocks and just holding them indefinitely, if you got an inheritance or something, is probably going to perform as well or better than using an index. But most people prefer the index. It feels better to do that. The S&P 500 index is rebalanced, all those things. I don't see, just in terms of how that works out mathematically, that you'd be any better off. So that's my point. EV to EBIT with the return on capital thing, or EV to EBITDA, I think EV to EBITDA is fine. So just take the S&P 500, let's say, and instead of buying all 500, buy the 50 stocks with the lowest EV to EBITDA. It sounds fine to me. But I have to say, the thing is, I think quality works, because I think moats work. But those sorts of things that the magic formula does include things that you would never buy, because they don't have wide moats. You can briefly earn a really high return on capital in a business without it having a moat. In other cases, you can have a moat without seeing a lot of examples of high returns on capital. Like we had the write-up recently about Games Workshop. You just learn about the business. You know it has a tremendous moat, whether it's earning a high return on capital or not. The reason it's not earning a high return on capital in a certain year is it's being mismanaged or something. But you can go and see how addicted people are to the game, how important the IP is and stuff, just that all that goes into it.
Which is the moat, right?
Yeah, which is the moat.
Sure.
And you can see that's what Buffett and Munger saw with See's Candy. You could raise the price and stuff. I mean, I bought a stock once, Breeze Eastern. It was not earning very high returns on capital in the years immediately before I bought it. But it was easy with some scuttlebutt and stuff to see that they could raise their prices a lot if they wanted to without losing customers and things like that. And I've owned companies before like that where I knew they could raise their prices. And my experience has been if you buy a company that you know could raise its prices and not lose customers, it turns out that regardless of what the screens say and stuff, that'll work out. But that's not captured by a screen.
Sure.
Like the magic formula doesn't capture that before the price increase. It says it's not earning a high return on capital,
Interesting. Do you think you would have considered Breeze Eastern an overlooked stock? I mean, it was a micro cap, and it was definitely
very illiquid. Yeah.
Cool. Next question comes from also somebody on Twitter, and he says, would you consider management's decision to be a dark stock as a negative mark against management's shareholder friendliness?
Yeah, so we could divide dark into two sorts of ideas. People often talk about dark stocks as stocks that don't file with the SEC.
Yeah.
Which is not really the same thing as dark, as in they actually don't give information to shareholders, except as lawyers insist that they do, So, the company would have to disclose certain things to shareholders if they, insisted on stuff, but they could do all sorts of things to put out as little information as possible to make it as impossible to get the information as they can, just really being a pain to everyone to try to get shareholders to go away, and there are companies that do that. So yes, that would be unfriendly to shareholders. In terms of not filing with the SEC, it's somewhat shareholder unfriendly, I would say. Although I think the importance of filing with the SEC is less than some people think. I mean, I research these stocks for the managed accounts, and I can give examples where I have much easier time researching the stock that doesn't file with the SEC than the stock that does. What you'll see with some of these small illiquid stocks is you can give so little information to the SEC and still be an SEC filing company. And it's just not helpful in terms of what the company's telling you.
Sure.
Whereas you can be not filing with the SEC and give me a wonderful annual report that includes examples of what you do and, specific sort of case studies of things and, mentions all sorts of different employees that you have and all sorts of things that I can figure out what your business is. You saw like the 10K of Maui Land and Pineapple or something. They give no information. The absolute minimum that you would have to give to have the SEC not tell you that you need to change your filing.
Yeah.
That's all that they do, and it's no more useful. So that's an example. So like Cool, KWL, doesn't file with the SEC. MLP, Maui Land and Pineapple, does. No one's going to believe that Maui Land and Pineapple gives more information to shareholders than Cool does, especially with Cool's current management, even though it still doesn't file with the SEC.
I was going to say,
way more.
KWO, they kind of put the pieces there for you to figure it out.
Yeah, they put out a recording of their annual meeting. They put out the full summary report from their appraiser.
Yeah.
I mean, just all this stuff that lots of public companies don't do. And then you have some public companies that try to tell you as little as possible. I've talked sometimes about how you have giant public companies like Alphabet, Google, and stuff.
You talking about Apple?
Yeah. Well, they don't want to break certain things out. So some of them that have like multiple, like Google's a good example where they have Google and they have YouTube. I think they are pretty, I'm amazed at how little they're trying to break out that information when those businesses would seem to me to be very, very different, incredibly different. And yet they, as long as they're allowed not to do it, they don't do it. So
interesting.
Now lots of analysts cover and stuff, so that's a different story. You get the information anyway.
Cool. And then the last question for today for this podcast says, what are some of the investor letters from other value funds that you make a point to read?
Small ones. I don't really read ones from big value investors.
I'd agree with that. Samir Patel, our friend, he's come on the podcast a couple times. Or once before. I like to read his. Who else do I like to read? But then I do like to read bigger firms, but really that's just more like fanboyish. It's not really because I think I'm going to get something out of it. Me reading about Pershing Square's investor letter is going to do absolutely nothing for focused compounding, right? Yeah. Just because, whatever, I like to follow them. Who else do you like to read?
I would say all small ones that we have let's see.
Greenhaven Capital.
Yeah, Greenhaven Capital.
His write-ups are always, I think, pretty good. Other people from Twitter.
I was going to say that almost all that I can think of are people that you follow on Twitter.
Yeah.
Or people that I know.
Peter Rabover, Artco Capital.
Yeah.
His letters are always pretty great. Who else am I thinking of? I gotta pull up my Twitter.
Yeah. So I mean, let's see. Are there any big ones that I read regularly? No, I don't think so. I think I just follow the filings mostly.
Yeah. Upslope Capital. At Upslope Capital on Twitter. His write-ups or his investor letters are always pretty good. But yeah, it's certainly in the smaller space. They're not like these legendary investors. This is where I'm spending more of my time reading.
Yeah. Also, I'm never sure with some of these when I'm reading something if that went out to everyone in the public.
Yeah, that's
you know
true.
what I mean?
Yeah.
With some of those things, so I don't know. I mean, someone forwarded something to me, but I mean, some of these are client letters basically. In some cases,
I got in trouble for passing around a couple of client letters.
Did you?
On Twitter? Not in trouble. They just asked me to remove it, and I was like, okay.
Yeah. So I don't know. I mean, the ones that we've mentioned are things where we've seen things where it goes out to lots of people and stuff. So I don't think it's a problem. But yeah, there's some cases where I probably read something that was originally a smaller group of people.
But my advice would be to anyone listening, if you're sort of investing for yourself or managing smaller sums of capital, I would probably spend more time reading smaller investor letters.
Absolutely. Yeah, definitely.
I think it's because they're really trying to market themselves. So a lot of them kind of pour their hearts into the letters, right? That's their best marketing material. So you could really learn sort of how they think about things and their thought processes on, certain ideas and stocks. But that's certainly where I would spend majority of my time.
Yeah, I'd say the big ones that I've read are pretty boring things.
Yeah.
But some of the really small ones are interesting, especially when they focus in on one stock and they talk a lot about it,
Well, you got to think like the bigger fund, right? How many lawyers does that have to go through?
Yeah,
I mean,
true.
like, for example, like, is it Third Point or Dan Loeb?
Yeah,
Is it Third Point?
Yeah.
I mean, he said that they don't even let him write the letters anymore. So, I mean, that was fun back in when he was Mr. Pink or whatever on message boards, and it's fun to Google and read a bunch of those old writings that he did, and letters and stuff like that. Yeah.
Yeah, whereas with us, you're still allowed to tweet even.
Yeah.
It doesn't have to go through a lawyer, so.
Yeah. Yeah, we'll try to keep it that way. That's true. Anyways, that's where I would spend my time, is go and focus on the smaller managers. So I want to thank everybody so much for tuning in with us, especially if you did come from our podcast on iTunes or Spotify and you joined us here on YouTube. Be sure to hit that subscribe button. And what that'll do is whenever we do upload a video, you'll get a notification about it. So focus compounding all the time. That's what we're talking about. So I want to thank everybody so much for tuning in with us. We hope you have a great day, and we'll see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.